folks, we got a big one today. Stocks to buy for the month of April. I hope you're excited because I know I am. And I hope you're excited over the next couple days because we got great things coming out. We're talking about the dividends payments for March. We're going to be doing that one shortly. I hope you're excited, but we're going to start with the stocks to buy for April, folks. Let's go, and potentially maybe even talk about a little portfolio update while we're at it. Okay, folks, as you see, we got four today. Four stocks today, several related to experiences, and we're going to start off with none other than the Walt Disney, okay? Walt Disney Company. Obviously, if you don't know who Walt Disney is, the company itself, you have to know, okay? Main revenue sources we have here are going to be both in media and experiences. Experiences containing the Disney parks. We're talking about Disney World, Disneyland, Disneyland Shanghai. Look, there's so much to do with this company. It's crazy. When you look at the entertainment segment, you're seeing theatrical releases as well as Disney Plus, and your linear TV, as well as they have through the acquisition of 21st Century Fox that they are benefiting from as well. So that is your main revenue source here for Disney. Why do I like this thing so much? Well, first off, you have to preface this by saying over the last year, this stock has been shmammered, down 23%. And if you look from their highs, it's down around 27% from their very high point back in early March of last year. The stock is down pretty significantly from there. And over the last 5 years, you've only seen a 25% growth. Again, this stock was up really only around 67% in a 5-year period, despite constant growth and great numbers. But what can I say? I think this thing is should be up a little higher than 25% in the last 5 years. There's a lot of reasons why. First, we look at the valuation of the stock and see what we see. Well, obviously, we see a terrible line when you're looking at a PE ratio standpoint. Forward PE still at 32. And why is this? Well, they are still in recovery mode in terms of revenue and profitability, and you can see that in many aspects. So we're going to get into that and see why that's the case. Price to expected growth only at 1, pretty cheap. Price to sales at 3 seems pretty high, but it's been continuously declining since it shot up here in 2020. So fantastic stuff. I'm okay with this in terms of that because of the growth factor that we're not baking into this. And here's a great website that'll show you basically anything you need to know in terms of annualized revenue for Disney. You see a constant growth pattern up to 2019. And then 2020 hit from a pandemic standpoint, and it shut down the parks entirely. So they had to find other ways to make revenue. That's where Disney Plus stepped in and did a fantastic number for them. And they're not quite at 2019 levels, but they've recovered quite significantly if you look at the full year of last year. Very nice. If you look at annual income, again, this is where you get the point where they haven't quite recovered to pre-pandemic levels yet. And a lot of that you have to consider is going to be not only in part to the parks, but you have to include Disney Plus in there. They pay so much for content and creation of content that they're going to be hitting a bit of a pain spot in terms of income for a slight margin. Let's just say it's going to be the case for a while, but they're working on avenues to fix that, which we'll get into shortly. If you look at quarterly revenue again, you can see this. You can see that as of late, good increases, very good increases. Media networks, really great stuff to see here. From a media network standpoint, you can see compared to Q4 2020 in comparison to Q4 of 2019, you see continuous growth there. Here is one issue that we saw. It was the studio entertainment. This includes movies, the movie segment, okay? And this was down big time when you look at 2020, as theaters were not popular anymore. We were kind of in the midst of everything going on. No one wanted to get sick. So what happened? That's right. No one went to the movies. Now we're seeing a massive shift in the trends. As of this year, people are going to movies very, very much. Okay? You can see with all the big blockbuster releases, the grossing income is continually rising. Continuously. No matter what it is, obviously. Not necessarily saying a Disney movie's been in that scope yet, but they haven't necessarily had a massive release. They did have Spider-Man No Way Home, which broke the mold, really, for what the new norm was for the box office. And now you're seeing other places, other movies break the 100 million mark, which hadn't been done in an opening weekend in years. And they're finally doing that. So there's great, great things happening in the studio entertainment segment that I'm really excited about. Big recovery and growth. But the main thing we're going to be talking about here is going to be the parks and experiences. Now this is one that obviously took a shellacking. You see Q3 of 2020, there was no operating of parks during this quarter. So you only saw a tiny 85% decrease. Tiny revenue line under $1 billion, which isn't where they're at. When you look at pre-pandemic levels, you'd point to this Q1 of 2022 where they put it $7.3 billion. And have they recovered to that level yet? No, they have not. So that's just an aspect of where they can be. It's pretty exciting to see that. And from a direct-to-consumer standpoint, not updated as of 2021 on this site, unfortunately, but we can get that data as well. This is going to be your Disney Plus line here, and you see continuous growth to a great degree here. Very exciting to see that. And when I talk about Disney Plus, what do we talk about? Well, Disney Plus subscribers, this is a great line for them. So Disney, you have to consider Disney is not just Disney Plus. Should have had it pulled up first, obviously. If I have to pull up the earnings report, I certainly will. Which I might. I might definitely do that, so don't worry. But here's what Disney's doing. So from a standpoint that is only related to Disney Plus, since they offer it such a cheap price still, they have made a change and decided to offer they've offered a new tier to Disney. They're going to offer a new tier to Disney Plus that is an ad-based model. It's a cheaper model, even cheaper than what they're offering. That's going to be ad-based. Pretty wild, but it's an effort to increase that revenue per user, because even though they offer it at a cheaper rate, those ad rates will then in turn boost the revenue they're making per user. So Disney actually makes more off of the cheaper model. That's just the case, just due to ad rates, and people will want to be running their ads on Disney Plus. Okay, this is where it's at. And here's a more updated line that you can see as far as what they're doing. So from a subscriber count basis, this is again still an old line, but as of last quarter, you saw they were sitting at 129 billion there. Hulu showing massive growth as well. Total Hulu up 20%. It's crazy. ESPN Plus showing massive resolve now, over 5. Or I think they just breached 20 million. They just got, obviously, Peyton Manning and Eli Manning. They got Joe Buck. Look, ESPN is adding the content that is going to get this into a relevant service, because it wasn't really a relevant service before. So from an entire streaming aspect, Disney's doing great numbers here. Okay, they're doing great things to further bolster this business. But obviously, parks recovery is my main focus here when I look at Disney. And why is that going to happen? Well, obviously, we're at a point of, you can't show this on YouTube, but look at this. Cases, ridiculously low levels. And the thing is, it's not going to come back, right? You got to consider that there likely will be a resurgence to an extent, but from a political standpoint, we're in an election year, and political operatives, they can't let it happen. This will entirely destroy all of their campaigns if everything they've been working for is still here. So they're doing everything they can to bury this like it never happened right before the election. Then maybe potentially in 2023 they could bring it back, but I don't believe they will, because I do believe that they are going to get slaughtered in the election year. So just being honest with you. Okay, that's Disney. What's next for you? Another experience. It's going to be Vici. Vici Properties. Might be one you don't necessarily know, but this is a real estate investment trust, REIT as some people would like to call them. They own a lot of casinos, primarily going to be in the Vegas area where you expect most casinos. So first we look at the stock's performance. Year to date, down 3% in the past year, a 2.9% increase, nothing crazy, and up 61% in the last 5 years. Has recovered massively from their dip during the pandemic, 135 since then. So a really great recovery, but really stagnant if you look at it on a year-to-date basis. We look at Vici. If you don't know what it is, again, we talk about what they contain. Let's look at the real estate portion of Vici, some of the properties that they own. 57% of their portfolio is regional, and 43% is on the Las Vegas Strip. So there's a lot of really, really great properties. Okay, browse by location. Well, what do they have? That's right, Caesar's Palace. That's a Vici property. Okay, Harrah's Las Vegas. That's a Vici property. Caesar's Atlantic City. That's a Vici property. Okay, some of these great places that you might know, doing great things. I mean, you know these properties, okay? You know these properties, and they're in great positions. They're great run properties. It's great stuff. So the Venetian, that's right. That's a Vici property. You know the Venetian. If you stayed there, it's rich people's city, okay? This is a company that's really got a lot of quality properties under their belt. As you see, it just keeps going. They've got so many quality properties that they own, and that's what really I like about them. Because when you talk about experiences, like I did with Disney, people are going to be resurging, and there really has been quite a resurgence onto the Las Vegas Strip, where a lot of people are going out now. A lot more people that weren't before are now going out, and you're going to see that benefit. You're going to see those people showing up to the Venetian. You're going to see those people showing up, obviously, to Caesar's Palace, because gambling going crazy as well. But great stuff for Vici. That's why I like Vici a lot. We look at the statistics. Not fair to look at really these ratios when you're talking about a real estate investment trust, because they trade off a little bit of different value. Price to book around 1.79, a little bit fairer to look at. When you're talking about Vici, not trading overly expensive. And you have to consider they've also agreed to acquire MGM Growth Properties for $17.2 billion. I really like this acquisition. You look at MGM Growth Properties, and they own, obviously, more on the Las Vegas Strip as well, that Vici is now going to own. The main push of this is to own more and more of the Las Vegas Strip, as well as just quality properties, and MGM Growth Properties really had that. So you're going to add this revenue to the line, and you're going to add the net income line to their line as well. More income generated, which then in turn will bolster their dividend. That's what I really like about this. So this is obviously MGM Growth Properties if I didn't show you. So this is going to continue to bolster the dividend, and Vici itself, if you look from a revenue standpoint, it's continued to see growth. I mean, they've been doing great numbers since 2018. Here you can see continuous growth on a revenue standpoint, and then you add in MGM Growth Properties, and you're going to be adding around 50% plus in terms of revenue. So that's really exciting to see that. And it'll also help improve this dividend, which is sitting at a 4.9% yield. Payout ratio under 80% is actually cheap for them, obviously, because they want to be around 80%. And they've only shown 3 years of growth. Nothing crazy in that aspect, because when you look at the history of this, once it loads, don't worry, it's loading. There was a little bit of a stagnant period here. I mean, I don't know. To me, that's pretty nice. Okay, I think that's growth in my perspective. But that's just because they've only been paying the dividend that long. Okay, look at this continuous growth. And obviously, this next quarter they'll be paying 36 cents, and then they'll up that. But once this MGM Properties purchase goes into effect, they'll be upping it again, because they have a lot of extra cash on hand, and that's what they're focused on. So that's why I like VICI Properties, mostly for the dividend play, but I think this thing's got room to grow. My next stock's going to be Ford. You've seen it on here before when it was under $4 a share. That's right, folks. I told you to buy it under $4 a share, and I hope you did, because I know I did. Ford's back in the money again. Okay, this is back in my interest yet again. And why is that? We've seen a terrible year-to-date performance, and really since their recent highs, down 30+%. Still at 41% on the year, but this recent plummet has me very interested in Ford stock. Okay, very interested. Let's take a look at why I really like Ford. Well, Ford, a lot of great vehicles when you look at Ford. From an SUV standpoint, great stuff. The Escape, the Bronco Sport is one that I really like. The Bronco's a beautiful car, okay? Explorer Edge. The Mustang Mach-E is included in here, the all-electric Mach-E. But they've been doing really well in terms of sales. It's a cheaper electric vehicle than, let's say, a Tesla might offer. So they've been doing great numbers on the Mach-E, despite it looking weird for a Mustang. From a truck standpoint, obviously the main source of their money here. Okay, this is great stuff. The Maverick, small, much cheaper truck that they offer, really nice. The Ranger is in that boat as well. The Ford Transit Connect. Vans are definitely something I'm very interested in for this company as well, because when you talk about electrified vehicles in the future, you talk about companies buying a lot of electric vans for transportation to be kind of ahead of that curve. The F-150 and the America's highest selling truck, and then they have the F-150 Lightning, which is going to be the biggest electric truck out there. Okay. Already the biggest truck in America. Now that same brand is releasing this electric, fully electric vehicle, which is going to be more future-centric. But we'll get into that in a second. And then obviously you have the Transit, as I spoke about before. From an electrified standpoint, this is what I'm talking about, the E-Transit. I hope you're excited on that, because it's going to be really nice. Really nice. First, we'll talk about the Ford Lightning. Why do I talk about the Ford Lightning? This is exciting. They're going to be starting deliveries and production here shortly. So they're working on production. They've had to stop reservations already because they had so many reservations, and now they're going to be working on orders. Then they'll be opening up that once they start delivering. So really excited on that. What's great about it? Well, they also have intelligent backup power. So this is a vehicle that, given the generator that it has, or really the battery that it has, it can power your home. So obviously not for like major things. Once your truck's charged, if the grid goes down, while it's on the charger there, you can plug it into your home and it'll power your home. So really exciting stuff. I mean, I don't know. I like it a lot. I don't know. I think it's a pretty cool thing to say that the F-150 then can power up to 3 days as long as 10 days if the power's rationed. So again, not turning on the lights too much and stuff like that, not using too many appliances. But I think that's a really cool aspect of the Lightning. Not necessarily the main selling point, but I think it's a cool aspect. Now, I'm going to preface this by saying I do think the push for electric vehicles is a little overblown. And here's why I say that. Currently, we don't have the infrastructure to support everyone switching to electric vehicles. It doesn't exist. We don't have the charging stations. We don't have the ability to produce that much electricity without massive burning of fossil fuels. It's not what it seems to be, right? This is one thing where they They sell you something and it's a complete lie, right? This is the case. Is it better for the environment? Maybe while it's running, but you have to consider the aspects that come with production as well as the electricity that it takes. It's not any better. How do we get that electricity? A lot of it's from burning coal, right? So that's how we're generating a lot of this electricity. And as far as the battery production, it's one of the most harmful things for the environment we can do. When you talk about lithium mining, it is horrible for the environment. So the same people that are clamoring about environmental aspects here, which again, look, I'm not going to be clamoring as much as they are. I won't. I just want to point out the massive hypocrisy that comes with this, because they are completely wrong. I mean, look at the effects of lithium mining. I just ask that you do that, just so you become informed of that aspect, so you realize these are not good for the environment by any means, okay? They talk about this is the most essential part of our life, but this could damage the ecosystem a lot harder. So I don't think the push necessarily is as heavy in electric as soon as you might expect, but I think this is a great, for a secondary market for them. I think this is great for Ford. That's my main point there. You look at Ford stock and it's dirt freaking cheap. Trailing PE ratio of 3.7, Ford P of 7.9. This thing is dirt cheap, folks. It's dirt cheap. Price to expected growth 0.38. Price to sales 0.49. How are they trading so cheap, guys? They're giving away this stock to you right now. From a revenue standpoint, they've been able to show some nice growth, not quite to where they were in 2019. Not a shocker because vehicle prices have risen. People aren't buying vehicles quite as much. But we're going to see a continuous growth line. Even if they continue to keep the revenue consistent, this stock is at a ridiculous dirt cheap level, and I like it. And you know it's at a dirt cheap level when an executive chair has purchased $4.5 million worth of shares. So great stuff there. And I will say they cut the dividend originally, and they now reinstated the dividend. So it's only at a 2.25% yield, but at a 5% payout ratio, there's so much room to grow with this dividend, and they will get it back to the 15 cents that it was prior to the reduction in 2020. You just have to wait. Finally, I have one bonus stock. It's going to be Kohl's. Why do I say Kohl's? Year to date, showing great performance. On the past year, only up 4.6% though. The past 5 years, up 56%, and has recovered since the dip in 2020, right? Massively since then. So I hope you bought in when I told you to, because I know I did, folks. Kohl's is here more of a bonus because, well, the main talk with Kohl's is going to be on buyouts, okay? There are a lot of companies, or really a lot of investment groups in talks of acquiring Kohl's, and this valuation is likely going to be $70 plus per share. And this right now, again, as you can see, is trading at $62 a share. So there's automatic money made right there. What happens when they're purchased? You have to mention this, right? They're going to go to obviously a private equity group and likely still be a public company and run very similarly, but these activist investor groups that are talking about buying them up will completely wipe out the management team most likely, and make some, not maybe significant changes, but mostly in leadership. So keep that in mind. But here's what happens if it isn't purchased, which I don't necessarily know if it will be. Just being honest, a lot of these activist investors, they don't actually pull through. So they've made offers, but they've been cheap. They haven't been expensive enough for what Kohl's deserves. And why do I say that? It's because the stock's trading dirt cheap levels. 9.6 PE ratio, 8.48 forward PE ratio. It's dirt cheap. Price to sales at 0.46, and they're trying to offer less than $70 a share for this thing. When it's trading at valuations that are ridiculously cheap, you're not even including the value of the property in these or in these offers. So I don't know if it's going to get purchased just due to the fact that they're not offering enough for this company. I think this company's really worth closer to $80 to $85 a share. I think is very fair valuation if you're talking about purchasing this company out. My nose got really stuffed out of nowhere for some reason, so if I'm talking weird, that's why. But the valuation just is dirt cheap on this bad boy. When you look from a revenue standpoint, they've really recovered right to where they were in pre-pandemic levels, where they had to completely shut down, so that's wild stuff. But they've recovered to those levels. And they're going to show continuous growth. So I like this company a lot. And they also offer a nice dividend, 3% yield, but only a 16% payout ratio. They've got a lot extra they could add on to this. Dividend growth's only been a year because they cut it back in 2020, as you might imagine. And they're not quite at the level that they were, but they easily can be. So I don't know if they're going to go a full year. I think they will. They're going to do a full year of this 50-cent line. And then from there, I believe they're going to grow it. Most likely, I would say they grow it back to 60 cents first, and then they'll eventually reach the 70-cent line, which they rose it to back then. But I think they're going to go from 50 to 60 cents, and then likely to 70 after that. So keep that in mind. Dividend looking beautiful. Those are my stocks to buy. I hope you had a great day. I know I did. Have a good one.